Chapter 4, Part 4, Cash Flow, doing the direct method. So again, we have two formats. We've already discussed the indirect method in Part 3. Now we're going to do the direct method. Now, cash flow from operations, you adjust each of the following items from the accrual basis to the cash basis. Cash received from customers, less cash payments to suppliers for supplies, operating activities, and income tax. And remember, these are always subtracted. I've seen on the homework where sometimes people try to add them in. Don't do that. And that will give you net cash provided by operating activities. So now let's look at the same comparative balance sheet that we looked at in Part 3, and we're now going to do the direct method. So again, we'd want to see the changes, and we're going to go through this. We're only going to do the operating portion since it's the same for the direct and indirect for the investing and financing activities. Here's our income statement that we used before. So, to do the direct method for operating activities, the first thing we're going to try to figure out is how much cash do we collect from customers. So what we need, two accounts must be analyzed. Sales adjusted for changes in accounts receivable. If accounts receivable goes up, that means part of our sales are non-cash, so we have to take it out. And if it went down, that means we have to add it back in because we received more cash than we made in sales. So we start with our sales, and we look at accounts receivable, and it had a beginning balance of $130,000. It ended with $155,000, which means it went up by $25,000, which means we have $25,000 in that $950. That's not cash. So what we're going to do is we're going to have to subtract that out. So now we've determined cash receipts from customers. That's the number we want. And we're going to put that on our cash flow from operating activities. Now we're going to look at how much cash did we pay to our suppliers. Now this is how I like to do it. You can do it any way you want. I look at these three accounts: cost of goods sold, inventory, and accounts payable. I know that if we have $600,000 in cost of goods sold, we would have had credited inventory for that amount. Now I can figure out how much we added to inventory. So, based on looking at the numbers, we would take the 75 plus the 600 minus the 61, the beginning balance, which tells us that would be 614. And the credit would have gone to accounts payable. And what you always want to do is check your T account. So if you take your beginning balance for inventory plus the 614 and purchases minus the 600,000 you sold, gives you an ending balance of 75, which means you've done it correctly. Now we put the 614 there, and we're going to determine, we know the ending balance is 66. So if we take 60,000 plus 614 minus 66, it tells us that we actually paid 608,000, which is going to go on our cash flow from operations. There's our 608. Now we're going to look at operating activities. We're going to adjust for accumulated depreciation because depreciation is a non-cash item. So we have to solve for it. We know that we sold equipment and we had to take out $6,000, which means $22,000 was depreciation expense. So, operating expenses, less depreciation expense, less the change in the allowance account, because you got to remember, if the allowance account went down by $2,000, what that meant is you wrote off some receivables, and that's non-cash. So, depreciation and the decrease in allowance for doubtfuls would reduce our operating expenses by $24,000. Now, then you can take a look at that, where that goes. The last we're going to do is income tax. We know that's what the income tax expense was, so how much did we pay? It would come out to be $43,000. Now we can plug that into our income tax cash. So now we know our net cash provided by operating activities is 48, which is exactly the same number we got doing the indirect method. And that concludes part 4.